Hello, everyone. Welcome to One Finance World 2026 Global Finance Conference. I'm Henning Stein. Today, I have the pleasure of speaking with someone who is defining what's going on in the investment world across Europe. That's Christian. Christian, you have done this for many years now, and I know you for many years. I still remember our conversation on your podcast last year, and I thought it was only right to finally return the favor and host you here. So for our audience joining from outside Europe, you should know that when Christian Röhl speaks, retail investors listen. Christian is the chief economist at Scalable Capital and a prolific author and analyst. But most importantly, Christian, like myself, you are an investor at heart, and you spent over 20 years now studying the markets, but also actively working to improve the investment culture in Germany, in Europe. And Christian, it's great to have you with us.
Yeah, thank you very much for having here, and congratulations for the platform you have been building up, discussing investment ideas and the basic of all ideas, the global environment.
Great. Maybe to start our conversation, I want to use a framework that I came across last year, which I find very useful, and it comes from Mark Haefele. You might know him, the Chief Investment Officer at UBS Global Wealth Management, and he wrote a book. I got it here. So it's a book on investments. It's called The New Rules of Investing, and he's using what he calls the 5 Ds. So that's basically demographics, deglobalization, it says decarbonization, digitalization, and debt. These 5, and I find these 5 pillars important because they give us almost like a framework, a structural framework. Christian, your own 26 for 2026, I think that's how you call that. They touch on many of these Ds, and you are often warned against, a watering can or peanut butter approach, where using that to diversify your portfolio, and emphasize why we should not bet against America. So maybe if you look at these 5 Ds, particularly the intersection of high debt, which is a issue in the US, but also elsewhere in the world, and then shifting demographics in the West, do you think the European retail investor is actually prepared for the reality that the old rules of safety, so to speak, no longer apply?
Henning, to be blunt, not really. In Europe, and particularly in Germany, we are still a continent of savers rather than a continent of investors. We are driven by interest rates. In Germany, term deposits remain the kind of holy grail. And in Italy, for example, government bonds are the default, often bolstered by state initiatives. However, we have to consider that there has been a remarkable shift in Germany over the last few years. I would call it a trio of progress. Number one, digital access via investment platforms such as Scalable Capital. Number 2, low-cost ETFs. And number 3, high-quality, low-barrier financial education. And these 3 forces together have finally turned some savers into shareholders, and seeing more than 14 million Germans active in the market and over 5 million ETF saving plans executed every month. This is a massive win. But we shouldn't pat ourselves on the back just yet. An equity participation rate of 20%, that's still far too low. We also have to be honest, the last few years have been, in general, an easy mode for the markets. Every buying the dip was rewarded almost instantly. And the real test for our new investment culture will come when investments stay underwater for 2 or 3 years. And in general, many people still cling to products that provide an illusion of safety, such as real estate crowdfunding or complex structured products, or most of all, traditional life insurances that are based upon sovereign debt. And people forget that a guarantee on paper money is worthless if the purchasing power of that money is eroded by the 5Ds that you have been mentioning. What we really need in Europe among retail investors is a fundamental mindset change. The greatest security isn't interest on paper, it's ownership in the global economy. Broadly diversified entrepreneurial assets. Those are the only hedge against structural shifts such as demographics and debt.
Right. And 20%, do you have a historic perspective? I mean, I want to test you now and ask you if you don't have that figure, but what was that, let's say, during the financial crisis? It must have been high as well and then went down probably.
No. It was already on a very low level, below 10% during the financial crisis, because the first attempt to create a German investing culture died after the new economy imploded. That was a
even
chance.
Earlier than, okay, 2000.
Yeah, with Deutsche Telekom, with the tech IPOs of the late 90s, we already had the first chance to establish an investment culture, but the states wanted to sell their telecom stocks and not establish investment culture, not guide people into capital markets. And we missed this chance, and now we have the second chance, and now we need to take it.
Yeah, interesting. I remember that time when the German media Bild-Zeitung was driving the Volksaktien, share for the people, and then a lot of people got burned during that time because it was basically a mono risk instead of what you said earlier, diversification, which is important. So maybe let's pivot to Europe. A year ago, there was much talk about Europe's awakening, and we realized we could no longer be complacent. And my view is that yes, we see some awakening in Europe, but it's not yet gotten out of bed. So we are aware of the risks, and we are not really moving yet. And I had a discussion recently with Anita Hauser, the banker, and we talked about UniCredit and Commerzbank, and I said, I really see a shift to a more formal voluntary offer as a smart tactical pivot here, but also the need to establish ownership in waiting is forcing these negotiations. But more importantly, we see still Germany pushing back from a political perspective. And then you see institutions like the ECB or the Commission, they're not really saying anything. You think, okay, doesn't it make sense to have a larger entity here evolving in light of the competition we see in the US, with JP Morgan being, almost 800 billion in terms of market cap, and we're talking about a unified merger here of 150 billion. So what's your take here in terms of that last call for Europe? Not specifically on that deal, but if we continue to let national politics block this kind of consolidation for banks, and I see that potentially also in other areas in the market, right?
Yeah, I really love your metaphor that Europe is awake but still in bed. It's the perfect description of our current paralysis. Yeah? On Sundays, our leaders give grand speeches about European sovereignty and national champions and banking and capital markets union. But on Mondays, they block the merger between UniCredit and Commerzbank because they want a German bank for the German Mittelstand. And you can't have both. Europe in general is failing on execution. Of course, there is political instability in major hubs such as Germany or France, and therefore we are avoiding the uncomfortable questions such as European deposit insurance. When will we finally unify the safety net? Or, of course, Eurobonds, if we really want a capital market and a currency that can actually compete with the US dollar in terms of liquidity and scale. Aren't Eurobonds the logical conclusion? I wouldn't say yes to everything, but we need to discuss these points on a top level basis. And of course, for someone from the liberal conservative camp, I know these are tough pills to swallow, but we have to swallow the toad if we want to make Europe great again on the European on the global stage. Just take another example. The Draghi Commission has made proposals to increase competitiveness. That's 2 years ago nearly, and yet very little has moved. Look at telecommunications. The EU Commission is obsessed with having 4 carriers per country to keep prices low for consumers. But this destroys margins and prevents the massive investments needed for digital sovereignty, another buzzword in every politician's speech. And we really need to prioritize scale effects over this short-term pure consumer protection. And the same applies to defense and aerospace. We are mobilizing money, but the structures remain fragmented in weapon systems, but also if you refer to satellite technologies, there are assets in Airbus, in Thales, in Leonardo, everything dealing with satellites, but it's too small each one. But together, these parts could be at least the attempt to compete with Starlink. And we definitely need the EU Commission to act as an accelerator here. And Airbus, of course, is the proof from its whole history from the 1970s. When Europe actually stands together and works together, we can build something world-class.
Yeah, I mean, and actually, it's a hopeful message because it shows how much potential there is. And I always say that Italy is a good example, right? I mean, you just do a little reform, and there's so much growth potential behind it. And in Germany, it's the same. We saw that in the 1990s with the reforms by Gerhard Schröder, right? I mean, they led to so much growth, they couldn't believe it themselves. And I think you're spot on the Eurobond. I never understood that discussion in Germany, in particular, where you are already bailing out countries like Greece. You do that with cash. Here, you have control over basically the distribution of the usage of the money through a Eurobond. Wouldn't that be the logical step, right? But it seemed that particularly the Liberal Party in Germany was against this, who are supposedly free market, but they were pushing against that. And the same for defense, you mentioning that. I mean, it seems that you need a trigger, almost like a crisis as a trigger to get to these points. And they're moving there slowly, but it could be so much more potential by just doing it, as you described. And one area where you've been a major force actually in terms of politics in in the German-speaking area, or in Germany in particular, was a pension system. And you have been very active in Berlin promoting a shift from traditional pay-as-you-go models to more capital-based system. It was interesting because I remember when I was, at high school, I was always wondering, why do we have this pay-as-you-go system in Germany? And countries like Chile are already moving to a capital-based system. And I was always told, no, that's not safe. That's very dangerous because you're investing in equities, right? That we know, and we are against this. So, and now if you moved a little bit here with other colleagues, the needle by a long discussion you had here on a political level, and the recent legislation, of course, in the Altersvorsorgedepot is, I think, a significant milestone. And It introduces now tax advantages, as far as I understand. You're moving away from that capital guarantee that you mentioned, that always suppressed returns in a way. And you're finally now opening the door for a more long-term perspective for savers to use equity, to use ETFs more effectively. And I'm wondering, Christian, you were a key supporter for that initiative in Berlin and played a huge role over many years. I'd love to hear from you how this legislation actually achieved this, or what actually was achieved, and where you think there's still gaps in the system for the average person. If you could talk a little bit about that.
Yeah, it's really a game changer and historic milestones. And after fighting for this for more than 10 years, of course, I'm very happy that we're now on the way. There is a lot you can criticize in details, and there are still points to be worked out. But we have to realize that for the first time in the history of the Federal Republic of Germany, the state has officially admitted now retirement planning works without 100% capital guarantee. It works without expensive and complex insurance products, and it works through direct participation in capital markets via funds, and especially because they are so cost efficient and broad diversified ETFs. And which is really important, that this is not only lip service. It's not the state saying, well, you should do this. That's already in every yearly letter you get from the pension system. But the state is now providing real incentives on two sides. First of all, you get direct subsidies, a grant of up to 540 euros for a contribution of 1,800 euros. So this makes nearly 30% subsidy. And the second point, we have tax efficiency. The depot is tax exempt during the accumulation phase up to a limit of 6,840 euros, allowing the compound interest effect to work at full power and not being taxed out. And together, this structure specifically favors small savers and families with the subsidies. And this makes it a real game changer, putting capital markets into the middle of our society. And of course, there are a new challenge, and the main challenge is communication. We have to explain to people that they don't need expensive advisors for this, that it's not complicated, that they can do it themselves with a digitally opened account and a cost-effective ETF on a global index, such as the MSCI All Country World Index. And of course, to be clear, this won't fix the massive holes in the statutory pension system on its own, but it is a vital first step. The Germans love state subsidies, and if there is a bonus involved, they will sign up. They want to get the bonus. Right. And this could be the spark that finally turns a nation of savers into a nation of investors. But
I remember 20 years ago, in fact, my time at Deutsche, there was this introduction of Riester Rente, right? And then I think that was very popular, but the major problem there was a guarantee and that suppressed returns, high fees from the providers was another one, and a lack of subsidy, right? So it's like, the amounts were not large enough to fill any of these pension gaps. And it was also discussed as a first step, but it wasn't nearly enough to solve that. And I'm also more hopeful with this approach that the Germans finally looking what are the Americans doing with 401k, what are the British doing, and trying to implement something like this. And so it will be very interesting how it evolves. You see that already?
Riester was too complicated, and it opened the door for many financial advisors that were nothing but financial salespersons, and
Right.
there were many margin-loaded products without any chance to deliver a yield for investors, and so. What we're seeing now with the Altersvorsorgedepot, it's much less complicated, it's easy, and we just have the challenge to make people understand how easy it is. And of course, there is another challenge for Europe again, because if we are mobilizing private capital, if we are turning savers into investors, we must pair this with less regulation and less bureaucracy in Europe, because otherwise all that fresh capital will simply flow into US tech instead of building European wealth. So if we want to keep the money here, we have to deliver arguments. And so we're again at the point of deregulation.
Right. Also capital gain tax, but I think that's less of a topic for a long-term pension system, right? Where probably you don't pay any capital gain tax on that one, I assume. But it's a broader topic for to generate a saving and a more flexible approach around investing, right? So I see that in Switzerland where we don't have that. Compare that with the US, where you sometimes make investment decision based on tax, which I think is a very wrong way to invest. You also have spoken about the Norwegian sovereign wealth fund, and so did I, basically more from an institutional perspective. Been looking at that system for a long time, and now you're basically saying that this is a gold standard for how a nation can actually turn capital into long-term security. It's disciplined, it's global ownership based, and citizens see what they invest in. I mean, it has, in my view, also a darker side when it comes to political decisions. We've seen that many times with the sovereign or sovereign wealth funds in general. But hey, I mean, there are political entities in the way, so then they can decide that they maybe don't want to invest in certain areas, and that's fine. But I think more importantly, in light of the demographic pressure we discussed earlier, do you think Europe or Germany specifically need to move toward this state-led sovereign fund model similar to Norway, or should our focus be more on strictly empowering the individual that you described earlier? I mean, I looked at that in terms of Norway. It's very interesting that we haven't done that in Germany, for example, right during the period of the privatization under Helmut Kohl. Telecom, you mentioned earlier, right? Post, all that money was then used to redistribute that for other social means instead of using that as a way to build a sovereign wealth fund, right? And the question is, have we missed the train here already, or is there still, you think, hope for building something similar?
Well, I really like the Norwegian Sovereign Wealth Fund because it's a great example for creating wealth for people, and this also in very high scale and with a great public mindset, because we shouldn't forget that the Norwegians started their wealth fund in the 1990s, but switched it to an equity dominated portfolio in 1999. And so they had the drawdown in 2000 to 2003, a small recovery, and then the financial crisis. And throughout this last decade, they kept on investing, and now they capitalize on the gains. So it's really the long-term perspective, and I think it's great to see that a nation stands to this wealth concept. Nevertheless, we have to admit Norway has an unfair advantage when it comes to the financing of the fund because they have oil revenues. Germany doesn't have this. We just have a silly energy policy, but that's not our topic today. Otherwise, it would become a very, very long talk. In Germany, we would have to fund the sovereign wealth fund through debt. And we definitely missed the golden window between 2015 and 2020 when interest rates were very low or even negative. And with 100-year bonds at 2% interest rate, we could have had the chance to fund such a vehicle, but instead the government of Angela Merkel with finance minister Olaf Scholz, who later became Chancellor of Germany, they used accounting tricks for short-term gain rather than implementing the long-term vision. But this is over now, and I think as far as we can say,
when you low interest rates, right? So
yeah,
otherwise you would, it's like a private investor, you basically take debt and you invest that in equity, right? Doesn't make sense if you pay too much on your debt.
Yes, and so we had a review of this idea as a generation capital with Christian Lindner from the Free Democrats as finance minister, but he also left the office then after the government broke down. And so we have to realize if we want a state fund now, it should follow rather the Swedish than the Norwegian model. And the Swedish model is redirecting a portion of the mandatory pension contributions into a professionally managed equity fund, which made AP7 fund the largest mutual fund in Europe with a great performance. This has also been discussed in Germany about 5 to 6 years ago, but it never made it into the political process. And of course, it's now time to move further. And if we are talking about sovereign funds, we also can consider that we already have a proof of concept for a German sovereign wealth fund. It's quite little known, but it's called the KENFO, the Fund for the Nuclear Waste Disposal. They have 26 billion euro under management, and they have proven that state-orchestrated asset management in Germany can work with solid returns and, of course, also, which is very important, free from political meddling. And this is the non-negotiable requirement for any pension fund. It must focus on ROI, not on a political agenda. Of course, you can have certain values and certain target, but there may never be the situation that such a sovereign fund invests into projects that are important to certain politicians because they are locally important or they have a certain agenda. A fund must be broadly diversified to deliver great risk-adjusted returns. And that is what KENFO really does. And so highest respect to Anja Mikus and her team who created this platform. But
that's very, I have to look that up. I haven't heard about that. I need to look that up. And I find that interesting what you mentioned with the political influence. You're spot on, I think, here with the Norwegian model, I think that you could say it's free of politics because they separate the investment side from the political angle, with the exception of exclusions, where they say, okay, no
Yes.
oil companies, no, maybe when there's a conflict in the world, certain regions we exclude. I think that's fine, but then they wouldn't force people to invest in certain projects. But then, in terms of the revenues you generate, the returns you're generating over time, would you envision that more as a way to help on the pension side, or is that more supposed to fill infrastructure gaps like you have in Singapore, for example, with a very successful sovereign wealth fund?
I think it is both, and it should be both different entities. I think for pension, especially regarding credibility and public acceptance, individual solutions would be likely better than a sovereign fund. Yeah.
Right.
Of course, we have a tax advantaged accounts that empower citizens. And of course, we also need significantly higher tax-free allowances for capital gains to reward those who take responsibility for their own future and who have been investing for years. So on the pension side, it's important to bring capital markets also into the state pensions and into the company pensions, will make the first and the second dominating part of the German pension system. With regard to infrastructure, there is a project outlined in the program of the current government. It's called Deutschlandfonds, so a fund for Germany. And the original plan was a state investment of 10 billion euro, which is leveraged by private capital up to 100 billion euro. And this fund would be specifically for strategic industries and for infrastructure. So rather an active approach. I think this might be an interesting solution if it is privately managed by people with experience in infrastructure, in private equity, in private debt, people who have an economic background and not a state background. And of course, we need such a tool, and it would be a great alternative also for private investors who buy infrastructure funds. Why not a fund that is dedicated to infrastructure in Germany or Europe? That would make a great investment alternative if, again, it is set up from an economic ratio and not from a political agenda. But this would be an investment product, not really something for the pension fund. But I think both projects show one thing, that we also have to put into the middle of society, that ultimately investing is about more than just wealth. It's about participation. When you own stocks, you're part of the economy. You participate in value creation and in growth. And this prevents people from feeling left behind and questioning the system. So, in fact, capital market participation is a tool for social stability, for politic stability, and we cannot afford not to use this tool.
Yeah, and I think it has also effects on technology, on infrastructure, right? People get excited about these things, and rather than seeing it, as you say, critical. And it's an income generator as well. Dividends are also part of equity, and they can stabilize the pension system over time. And I always look at that from, the US is a good example. They don't have a sovereign wealth fund, and they've been discussing how to do that. And they're in a much more difficult situation compared to Germany because of the high debt level they have, right? So I think, countries like Singapore are a great example because they didn't have any resources. They had nothing. And look where they are now. So I think having people like you enforcing that or supporting that from a capital market perspective and educating also our policymakers, I think is really essential. So thank you for your insights today, Christian, and your work, as I said, in promoting this better investment culture is really important, particularly in Europe. And always value our friendship, your perspective as a fellow investor. Thank you for being part of One Finance World 2026, and I look forward to our next conversation. To our audience, thank you for joining us. We will see you in the next session.